If you're still guessing when to buy, when to sell, or how much to risk before every trade, you're doing it backward and it's costing you money. The truth is, most beginner traders never learn this one simple thing that separates the pros from the crowd: a clear, repeatable trade plan. Most beginner traders struggle not because they're unlucky, but because they lack a fundamental tool every pro trader uses: a solid trade plan. Today, I'm going to walk you through a simple yet powerful framework to build your own, step by step, that will transform your trading from a gamble into a structured business. You'll learn how to define your entry, your exit, your risk, and even how to manage your time frames, all laid out so clearly you'll wonder why you ever traded without it. Stick around, because by the end of this, you'll have a blueprint to stop guessing and start trading with confidence. Let's be honest, trading without a plan is like driving a car blindfolded. You're just reacting to every turn, every bump, every sudden stop without knowing where you're going or how to get there. This often leads to emotional trading. You buy because of FOMO, you sell out of panic, and you end up with random, inconsistent results. One day you're up, the next you've given it all back, and you can't even tell yourself why. Without a plan, your trading isn't a strategy. It's just hoping for the best. A solid trade plan, on the other hand, gives you clear answers. It defines exactly when you get in, when you get out, how much you're willing to lose, and even the best time to look for opportunities. It removes the emotion and replaces it with logic and structure, turning chaos into order. Step 1. Define entry rules. The first step in building your indestructible trade plan is to define your entry rules. This isn't about chasing hot tips or gut feelings. Professional traders use specific criteria. Here's a common, powerful approach: top-down analysis. First, you identify the overall trend on a higher time frame. Let's say the daily chart. Is it clearly moving up or down? Next, you wait for a pullback or a consolidation on a lower time frame, maybe the 4-hour chart. This is where the price momentarily goes against the main trend, offering a better entry point. Finally, you look for a confirmation signal on that lower time frame. This could be a specific candlestick pattern, a break of a minor trend line, or even an indicator signal that tells you the pullback is likely over and the main trend is about to resume. For instance, imagine the price of your favorite stock is clearly trending up on the daily chart. You then drop down to the 4-hour chart and notice it pulls back to a key support level, or maybe a moving average. Now, you don't just jump in, you wait. You wait for a strong bullish candle to form at that support level, signaling buyers are stepping back in. That combination, daily uptrend, 4-hour pullback to support, and a bullish confirmation candle, that's a powerful, rule-based entry. It takes the guesswork out of the equation and puts you in control. Once you know when to get in, you absolutely must know when to get out. This is where most beginners make huge emotional mistakes. They hold on to losing trades for too long, hoping for a turnaround, and they exit winning trades too early, fearing the profit will disappear. Step 2. Clear exit rules. Your trade plan needs clear exit rules, a stop loss and a take profit target. Your stop loss is your safety net, point where you admit you're wrong and cut your losses. Always place it at a logical level beyond a swing high or low, where if the price hits it, your trade idea is clearly invalid. Step 3. Your take profit target is where you aim to cash in your profits. A common effective strategy is to aim for a minimum 2.1 reward to risk ratio. This means for every dollar you risk, you're aiming to make $2. So if your stop loss is set to risk $50, your take profit should target at least $100. Sometimes for longer-term trades, you might also consider a trailing stop. This means as the price moves in your favor, your stop loss also moves up, protecting more of your profits without forcing you out of a strong trend too early. Planning your exits before you even enter a trade helps you avoid those emotional pitfalls entirely. Step 4. Manage your risk like a pro. This step isn't just important, it's the foundation of long-term trading survival. If you don't manage your risk, you won't last. The golden rule in professional trading is to risk only a small percentage of your total trading capital on any single trade. The most common recommendation is the 1% to 2% rule. This means if you have a trading account of $5,000 and you decide to risk 1% per trade, your maximum loss on any single trade is $50. Why is this so crucial? Because even the best traders have losing streaks. Imagine you have a losing streak of 5 trades in a row. If you're risking 1% per trade, you've only lost 5% of your account. That's manageable. You can recover from that. But if you're risking 10% or 20% per trade, a few bad trades can wipe out a significant portion of your capital, making it incredibly difficult to bounce back. Risk management isn't about avoiding losses entirely. It's about making sure that when losses happen, they don't knock you out of the game. It keeps you alive, allowing you to learn from your mistakes and continue trading another day. Step 5. Choose your time frame structure. Another key element is understanding how different time frames work together. This is called top-down analysis, and it gives you context and precision. You typically want to use a higher time frame to define the overall market context, like the trend, and a lower time frame for precise entry and exit timing. Think of it like this. Your higher time frame is the big picture map showing you the main highways, while your lower time frame is the street view, helping you find the exact address. For example, many traders find success using a daily chart or a 4-hour chart to understand the broader trend direction and key support or resistance levels. This higher time frame tells you if the market is going up, down, or sideways. Once you have that context, you then zoom into a lower time frame like the 15-minute or 1-hour chart to look for your specific entry signals and manage your trade. This combination allows you to align your trades with the larger market movement, giving you a higher probability of success while also finding optimal entry points. It's about leveraging the best of both worlds. Step 6. Write down your plan. This might seem simple, but it's where many beginners drop the ball. Professional traders don't just think about their plan, they write it down, every single detail. Your trade plan should be a living document that includes everything we've talked about. Your specific market conditions, what kind of environment you trade in, your precise entry rules, your clear exit rules, your strict risk management guidelines, and your chosen time frame structure. It should also include a review process, so you can look back at your trades and improve. Writing it down forces you to be specific. It eliminates ambiguity. When you have your plan documented, trading stops being about gut feelings and becomes a structured business process. You're no longer reacting. You're executing. This written plan acts as your personal trading constitution, guiding every decision and keeping your emotions in check. It's the difference between running a lemonade stand and running a multi-million-dollar corporation. One is ad hoc, the other is systematic. Make your trading systematic. A trade plan isn't a luxury for professional traders. It's a necessity that turns random, emotional trading into structured, disciplined decision-making. It's the roadmap that keeps you from getting lost and ensures you stay on track towards consistent profitability. If this helped you finally see trading as a planned business, not a random guess game, hit like and subscribe to Online Trading Hub, because next we'll build a template you can copy and paste for your first trade plan. Comment below with which part of a trade plan feels hardest for you: entry, exit, risk, or time frame, and I'll give you a personalized tip you can use today.